Hello everyone, this is Kevin Zhao, your finance professor at NTSU. This is the continuation of previous video, chapter 9 and 10, from earnings to cash flow. Previously we dealt with operating lease, and right now it's time for us to deal with this R&D expense. R is research, D is development, and a lot of companies spend a tremendous amount of cash in R&D expense. And the current GAAP, current accounting standard, only allows company to treat R&D as operating expense, which means this amount of expense will reduce the amount of revenue in calculating net income. However, the nature of R&D is truly for long-term growth of the company. It should be treated as long-term expense or capital expenditure. And the magnitude of R&D is significant. On the average, more than 10% of operating income are R&D. And for certain industry, the R&D, the percentage of R&D of operating income is even higher, such as technology. Computer industry has more than 50% of operating income was expensed as research and development. So this is a pretty important item for us to deal with, especially in certain industries such as information technology, healthcare, pharmaceutical, and even for other industries, it's pretty significant. And on the market, the average is a little over 10%. So here the nature of R&D expense. R&D expense by accounting standard can only be reported as operating expense. However, R&D is designed to generate future growth, which will benefit the company in the years to come. Therefore, in nature, it's a long-term asset. Therefore, R&D expense should be treated as capital expenditure. In order to adjust the earnings, we needed to do R&D capitalization. First of all, we need to specify the amortizable life of R&D, typically 2 to 10 years, but depends on the nature of the businesses. For a typical pharmaceutical company, I would say R&D was the amortizable life of R&D would be 7 years. That's the time period for the pharmaceutical patent. For other industries, could be 10 years or 5 years. It really depends. And the second step is to collect the past R&D expenses as long as the amortizable life. Then you add up those unamortized R&D over the time period to get a total R&D assets value. So if your amortizable life is 5 years, then research assets can be obtained by adding up 1/5 of the R&D expenses from 5 years ago, 2/5 from 4 years ago, so on and so forth. Now let's take a look at one example to see how we can make this capitalization happen for a company called SAP. What is SAP? SAP is a enterprise information system company and headquartered in Germany. It's a rival for Oracle, and both company does information system for major U.S. corporations and global corporations as well. So for SAP is a very typical technology company, and SAP invests tremendously in its R&D. And the current year, in year 2004, SAP invested a little over $1 billion in R&D. And here we assume that the amortizable life for the R&D expenses are 5 years. Then we collect past 5 years R&D expenses in this table. For example, in the last year it was $993 million. 2 years ago that was 909 million.39, so on and so forth. And then we calculate the unamortized portion of R&D for the current year. That's 100%, and for the last year, that's 4/5 4/5, which is 80%, and for 2 years ago, that's 60%, so on and so forth. And here we can add up the value of research assets, which is the unamortized portion of R&D expenses during the last 5 years, as well as the current year, which equals 2.9 billion euros. Because SAP is a German company, they use euro as its currency. Amortization of research assets would be one fifth of total value of research assets, which equals to 909 million US dollars. So here, the operating income was underestimated when you use the current year R&D expense as the true R&D expense. The true R&D expense should be the amortization of the research assets, which is the 909. So the difference is 117 million US dollars, which means operating income was underestimated, and to recover the intrinsic earnings, the income needs to be increased by 117 million US dollars. So that's the impact of capitalizing R&D expense on SAP's company's operating income in the year 2004. And this capitalization of R&D has tremendous impact on all financial metrics of this company. And this table showed you the impact of this capitalization on income statement, the balance sheet, capital expenditure, cash flow, as well as return on capital. So all ratios, all numbers will have tremendous changes. In the income statement, previously, the after-tax operating income, EBIT times 1 minus T, was 1285 million US dollars. But after the adjustment, it increased to 1359. The difference is 117 million US dollars, which means the intrinsic earning should be 117 million US dollar higher. That's for after-tax operating income. It's also the same for the net income. Net income should be adjusted upwards by 117 million US dollars. That's pretty significant. And the second, this adjustment have impact on the balance sheet. On the balance sheet, you will have nearly 3 billion US dollars added as assets. It's a long-term intangible assets. And on the right side of the balance sheet, you will have almost 3 billion US dollars added in total equity. Previously, it was 3.7 billion, and after adjustment, it'll go up to 6.78 billion US dollars. Capital expenditure was 2 million euros, but when you add this 117, the net capital expenditure would be 119 million US dollars. 119 million US dollars. And the cash flow stayed the same, but the return on capital would be significantly different. Previously, it was 29%, but after the adjustment, it go down to 19%. So this capitalization of R&D have huge impact on all financial metrics of this company. If you don't do it, then your valuation would be inaccurate or not great. But after this adjustment, you will see more realistic valuation. So that's research and development expenses. What about one-time and non-recurring charges? That's an easy item to deal with. And typically, you exclude one-time and non-recurring charges from your earnings estimation. Here's one example. Let's say you have a company reporting loss of $500 million due to one-time charge of $1 billion. Right? This company actually lost the money on one-time charge, which is $1 billion. And on the book, it looks bad because this company lost $500 million US dollars. But what's the intrinsic earning you should use in your valuation? Well, the answer here is B, the profit of $500 million, because when you exclude this $1 billion one-time charge, the company is actually making 500 million US dollar profits. So other than two major issues, operating lease, IND, as well as one-time recurring items, what are other issues that you need to be careful when you look at those accounting numbers and accounting earnings? So here's the thing. A lot of companies actually do so-called financial shenanigans, and the accounting numbers are not reliable because management are motivated to manipulate those numbers due to compensation concerns. For example, they wanted to have a good number for their net income, operating income. Therefore, they may overestimate earnings on their book. Although those manipulation could be legal or illegal. If it's illegal, it's outright fraud. But in most cases, those manipulations are legal, which is allowed by the current accounting standard. So financial analysts should be very careful on those financial shenanigans, trying to catch those irregularity in their financial reporting and to recover the truth of earnings. There are many signals that investors need to look at. Trying to identify those financial shenanigans, such as income from unspecified sources, income from asset sales, sudden changing standard expense items, frequent accounting restatement, change of their auditors, so on and so forth. So those are financial shenanigans that analysts need to look very carefully in addition to operating lease, IND, one-time non-recurring items, so on and so forth. So that's a pretty challenging work for a lot of financial analysts. It's pretty dirty work because you have to do a lot of adjustment to recover the truth of their financial condition as well as operating performance. But you have to do that. If you don't do that, the numbers are pretty biased and your valuation would be useless. Okay, here's a picture on how we deal with negative and abnormally low earnings. And don't worry about this one at this point, and we'll go through a chapter later on to systematically deal with abnormal earnings. What about the tax rate? And I think the rule of thumb here is to use the effective tax rate that you see from the financial statements, not the marginal tax rates or other tax rates. But anyway, yeah, effective tax rates. And for multinational companies, you want to use the weighted average tax rates across the different country where a company operates. And in some cases, effective tax rates may not be a good number to utilize. Probably you want to use the marginal tax rates. By using marginal tax rates, we tend to understate the after-tax operating income in the earlier years, but the after-tax operating income is more accurate in the later years. So that's one thing that you need to pay attention to. If you choose to use the effective tax rates, then you need to adjust the tax rate towards the marginal rate over time. Capital expenditure. Company have may release information about capital expenditure, but investor need to adjust the total capital expenditure by including R&D, by including this operating lease, as well as merger acquisition that the company is going to conduct or has already conducted recently. So that's capital expenditure, not the stated capital expenditure. So here's one example on Cisco back to 1999. And this company did a lot acquisitions. This company acquired many companies in year 1999, and the total value of acquisition is 2.5 billion US dollar. But this 2.5 billion US dollar is not included in the stated capital expenditure. Therefore, we need to add it back. And also, we need to make an adjustment on R&D. R&D expense was 1.6 billion US dollars, but amortization is only 4.8. So the net capital expenditure should go up by 1.1 billion US dollars plus acquisition. So that's almost 3.1 billion US dollars. An adjustment that we needed to add into this capital expenditure calculation, because the stated capital expenditure is only 584, and also the depreciation is 4.8. So the net capital expenditure was only 100 million US dollars. But after adjustment, you see the number increased to 3.7 billion US dollars. You have to do the adjustment, otherwise your numbers are totally wrong, because your net capital expenditure without an adjustment is only 100 million, but after adjustment 37 billion. That's 37 times higher. The last issue is working capital, and if you do no matter you do free cash flow to equity or free cash flow to the firm, you have to exclude changes in working capital. And what is working capital? Working capital is the difference between current assets and the current liability. That is cash the company has to invest to make their long-term investment project to operate. And for the company that has lost cash, then we need to be careful, because here we need to calculate the non-cash working capital, because cash sit there doing nothing, right? If you include a large amount of cash there, then you may underestimate or overestimate working capital investment. And the non-cash working capital equals inventory plus account receivable minus account payable. That's the pretty simple and easy way to calculate working capital if a company has a large amount of cash. And how to estimate working capital in the future? Well, the most popular way is to look at a percentage of working capital versus sales. And typically we estimate the percentage of sales as working capital. If you assume that the percentage is 3%, then in the future, if a company has higher sales, then the investment in working capital will follow. And some company may have negative non-cash working capital. In that case, should we use negative number? The answer is no. Practically, if you found a negative, then we should set it as 0, and it's negative. Right, so that pretty much conclude chapter 9 and 10. Once again, this is a very intensive week, and I expect everybody to spend more than 12 hours reviewing those 4 chapters. Pay a lot of attention to illustrations, and then work on your first exam questions as well as your evaluation project. Once again, if you have any questions, visit my office and send my email. I'm always here helping you out. The first exam will be due next week, so yeah, you guys need to work really hard on your first exam. And the first exam, frankly speaking, is relatively easy compared to the second one, the third one. But still, you need to invest a large amount of time solving those problems. And you may spend 2-3 hours, but some people may spend 4-5 hours. And my recommendation here is spend as much time as you could on a take-home exam. And the more that you invest in those Excel spreadsheets, the more that you can get away from these classes. And some financial models that you put in your Excel spreadsheet could be very useful for your future financial analysis jobs. Once again, this is Kevin Zhao. I'm your finance professor at MTSU, and I hope you enjoyed this video. while you're working really hard this week, and also hope you enjoy your time this week. I will see you next week. Thank you.